If you look at the definition of liability, right? If you look at the technical definition, now we all know that a liability is something which is a pronoun. I want you to be familiar with the terms, guys, right? We're talking about a present obligation, that is something which is there as at the balance sheet date. So if you look at the subsequent event, and we spoke about events existing at the balance sheet date, subsequent to the balance sheet date, right? So these are stuff which has already happened, right? It's a present obligation to do what? Either transfer an asset. So if you have availed of a service, you have to pay for it. So if the service has been availed, you have to pay for that service. So you have to pay in cash or provide services, right? So you have to give something in order for something that you've already received. And that has already happened. So it's a present obligation. If I'm staying in somebody's apartment, that stay period has happened and I am going to accrue the rent, utilities. All of these are examples of liabilities. Okay. So what is a liability? It's a present obligation to transfer the assets or provide the services as a result of past transaction or event. That means it is there on my balance sheet and I've already. So if you tie it up with BC, there's something called a executed contract. One of the parties of the contract have already performed their share of the obligation. This is that part, right? And since it has already happened, so when I say past, we refer to the end of the balance sheet. It has already happened and the liability exists on the balance sheet date, and I do not have a choice to back out. So it's not in my hand now not to pay. It's like saying I've called a vendor, he's coming, so I need a plumber. He came in, he did his services. I didn't negotiate with him. And then he tells me, this is the amount that I need to pay, even though that is 3 times the amount. Can I back out? The answer is no. Because all of that negotiation should have happened before I asked him to do his part of the job. But the moment he does his part of the performance obligation, I am obligated and I cannot avoid paying him or her. That becomes a liability in my balance sheet. So even if I tell him, okay, you come tomorrow, I'll pay you. He will still come tomorrow and I still have to pay, right? So that's a liability technically. So if you look at it, how do I classify this? Now, I want all of you guys to put your thinking caps on, okay? Bring all the practical experience that you've had so far. And let me see how many of you can think of constructive examples. I'm going to give you good examples, good questions, and I want you guys to apply your brain and answer it. Does not matter whether you're true, whether you're correct or incorrect. What is all important is how are you able to address these topics, okay? So if I'm able to classify, how do I put the liabilities in the balance sheet? Under what situations can I have a different treatment? If I put them in the silos, how do I put it? One, we all know, right? Current versus non-current liability, right? So what is a current liability? Something which is due in the next operating cycle or a year from now, whichever is longer, right? This is what we say, right? And we also say that, now see, technically, if you look at the definition, that will help you understand the questions I'm going to put you after this. See, what's a current liability? We say it will be extinguished with the current assets. That means something that I pay in the current assets or through the incurrence of other current liability. That means there is an item in my balance sheet in the liability section in which either my asset goes down or in order to pay one liability, another liability comes. So one comes down, the other increases. It is something like that. But both this and this has to happen in the current section of the balance sheet. That means it has to be something which is a current asset or a current liability. So if one current, so remember we said that balance sheet always has to tally. So if I'm bringing down one liability, either another current liability has to go up or the asset section has to come down. But it has to be from the current section if you want to call it a current liability. It's either has to be 1 year of the balance sheet date or the operating cycle, whichever is longer. So it's either 1 year or the operating cycle, whichever is longer. And since it is less than a year, we generally don't bother ourselves with the PV. Why? Because ideally the interest rates do not change so much in a span of a year. That's the reason we say that we generally put it on the face or the nominal value. We do not show it at the discounted value. Is this clear to everybody? Any questions here? Because now I have 2 questions from you. Okay. First question. Give me an example of a current liability, which is chilly, something which is due in the next 1 year, but it is not current liability. Have you understood the question? There is an item in my balance sheet which is due in the next operating cycle, but I'm not classifying it as a current liability. Can you think of that example and tell me? Yes? Something which is due in the next one operating cycle, yet in my books I've called it a non-current liability. Look at the definitions very well. You will get your answers from there. Anybody can think? These are chocolate questions, right, guys? I don't think these will be tested in your exam, but this will definitely increase your conceptual clarity on the topic. Think. A long-term debt is a non-current liability, right? What do you mean by long-term debt portion? Then how is it due in the next 1 year? And if it is due in the next 1 year, then why will you call it? Then you have to call it a current liability. No, then how can it be a non-current liability? I want everybody to try, guys, okay? It may be wrong, but I want you to give it a try. Think of an example of a liability which is due in the next 1 year, yet I'm calling it a long-term liability. Yes? Sharad, you're wrong. Short-term what, Sudhir? No, Argo, it is incorrect. Deferred tax liability are always short-term. Yes? Deferred tax liability, okay. You have to explain it. When do you think it can be a non-current liability? Short-term debt about what? So if it is a short-term debt, it is current liability. Why will you call it a non-current liability? Yes? Who was this? Sharad. Sharad, you have to think a little bit more. You are somewhere on the right track. Nobody? Present benefit, pension benefit. Please don't give me bookish answers, okay? Think and then tell me. Share application money to be refunded. How? Joseph, how? See, guys, you have to tell me contract liability in general, why will it be not long? Why will it not be short term? Rahul, a contract liability I told you is always a current liability, right? We don't book it as a non-current liability, isn't it? So most of you guys are able to touch upon the topic, but you're not able to tell me why will you classify it as a long-term liability. Think. Probably many of you are correct, but you have to be very specific. See, what we are saying, if we have to pay them, what has to come down is a current asset. So if we do anything by which a non-current asset is coming down or a non-current liability is going up, it becomes a non-current liability. Have you understood this, guys? See, the definition is very clear. In order to satisfy that liability, either a current asset has to come down or a current liability. Now, I've given you a very big hint, guys. Now, for all the examples that you gave, think about like this. See, Chara told me about bonds being retired, right? So let's say I am on 31st of December and the bonds are due for retirement on, let's say, March or in April or March, right? Now, ideally, that makes it a current liability. But what if I have created a sinking fund for that bond? Now, sinking fund is a long-term asset, right? Because it's a long-term investment asset. So if I am retiring it with sinking fund, then it becomes a non-current liability. Sharad, did you understand the answer now? A bond retiring in a year is not a non-current liability. It becomes a current liability. But if you are using a non-current asset to satisfy it, then it becomes a non-current liability. Have you understood this, guys? A short-term loan that is going to be refinanced by a long-term loan becomes a non-current liability. Why? Because you are going to pay it off with a long-term liability. Is this making sense, guys? Also, see another very good example. You have a notes payable, which is a current liability, right? But if the agreement says, the promissory note says that it will be paid in the common stock of the issuing entity, then it becomes a non-current liability. Have you understood this? So general rule, a current liability is something which is due in the next operating cycle or a year, whichever is longer. But in case, if there is a due in the next 1 year, but you don't pay it in your current assets, or in your current liability. That means you paid in a non-current asset, like a bond payable, which is going to be satisfied via a bond sinking fund, or you don't pay it via current liability. In other words, a notes payable that is going to be paid in terms of stock, or a short-term loan or a short-term liability which is going to be funded by a long or refinanced in a long-term liability. That becomes a non-current liability even though it is due in the next 1 year. Is this clear? Was it interesting? So think, same thing, same concepts, but all that you have to do when you're doing finance is, guys, open your eyes, and whatever you have learned, whatever you have read, that is why I say please read a lot. Whatever you have learned on job, in job, wherever you're reading, connect everything. That's possible. Okay. Now, if this is clear, you know that anything which is not current will become non-current. Now, give me an example of a liability. Okay. Which is just the reverse of what I asked you, right? Payable which is longer than a year, but it is still current. Can you give me an example? Whoever gives me this example, these are chocolate questions, guys, okay? Think payable longer than a year, but you still call it a current liability. Can you think of any such example, guys? Anybody? Can you think? Kishore is not there today. Okay. Can you think, guys? Why? No, Sharad, there is no logic. Why will pension be payable then? Why will pension be current? It will be non-current, no? Why will it be current? Don't give me bookish answers, Sharad. I want you to step out and think of it practically. You cannot get the answers to these questions in books. Why will not payable be a long-term, will be a current liability? Then why will you classify it as a long-term liability? So the question is very simple. It has to be a long-term liability. So it has to be a payable after a year, but you're still calling it a current liability. Anybody? Joseph and Aishwarya, you should have been able to take this question because this belongs in your level of activity. Okay, let's think about this scenario. Okay, we have guaranteed a debt of somebody else. So I'm a guarantor. So ideally, it is a contingent liability in my book. Okay, or let's say that it's a long-term obligation that you have. Okay, so I have taken a loan. Okay, look at it like this, guys. Okay, I have taken a long-term loan. In that long-term loan, one of the covenants of the loan is that my current ratio has to be around, say, 2.5 or 3, whatever it is, right? So whenever somebody gives me a loan, I have a stipulation, a required stipulation. So one of the stipulations says that you have to maintain a current ratio of 2.5. The moment my current ratio becomes less than 2.5, even though that loan may be repayable in 5 years with principal and interest, don't you think immediately the moment it falls, the moment my current ratio falls less than 2.5, I am immediately supposed to repay the loan, isn't it? Ideally, the moment that stipulation or that covenant has been breached, I am supposed to now accrue for it in my books because there is a possibility that the other party can ask me for the money. Then it becomes a current liability. Have you understood this? Is this clear? Is the concept clear? Understand, guys, if it is payable within a year, ideally it is a current liability. So you have to look at a situation where anything which is not payable within a year can be forced for you to be paid within the next year. Then it becomes a variable interest entity is not this, Rahul. You have to tell me what example are you actually thinking. Because if I just look at VIE, why will it be a current liability? Okay. So either you state your example in greater details, but you got the idea, right? Yeah, Rahul. You mentioned it in the chat
Yeah,
panel first.
yeah. Actually, what I was thinking is, since a variable interest entity, yesterday we learned that it is essentially an liability. If suppose that liability we have to, as and when it falls
Yes.
due.
Yes,
So
exactly. Yes, exactly. The moment it is falling due, you're correct. The moment it is falling due and I'm supposed to be paying it, then it
yeah,
becomes a current liability. Yeah, but see, what is the difference? I'll tell you. Why did I change my example from a guarantee? A guarantee is not a long term liability in your books, it's a contingent liability. Got it?
Correct. Even VI is like a contingent liability, no?
Yes. That is the reason I changed. I rephrased my example. Because those are non-contingent liability. So basically, it is not featuring in your balance sheet anywhere. It's in your notes, and now you're going to bring it in your balance sheet. But the example that I gave you later is something which is already there in your balance sheet, but you're going to classify it as current liability. Is this clear? Now, one thing I wanted to really understand is that bonds payable is a long term in general, but the year in which the bond is supposed to be paid, within that year, that one operating cycle, you will have to reclassify it as a current liability. Sharad, have I answered your question? Normal situation, it will no longer remain a non-current liability in the last year when it was going to be due within the next operating cycle. You have to classify it as a current liability. Is this clear? Okay. So now see, these are the stuff that we can do extra. Otherwise, there is nothing to teach you in this section. In fact, the entire section. So we're just going to brainstorm and talk about certain good examples in this session. That's it. Okay. Now see, another thing by which we can classify the liability is whether it's a definite liability, something that we are sure of, and there is no uncertainty around it, right? So when you have availed of a service, just the bill is pending and the courts and everything has been clear, and you know this is the amount which is going to come. It's a definite liability. A contingent liability, on the other hand, is a liability which is the amount or the occurrence of which is dependent on an event which may or may not happen, like warranties. I am giving you a warranty claim when I'm selling you a product, but you may or may not claim that warranty, right? Or, for example, a lawsuit. Somebody has already filed a lawsuit, or let's say, okay, I'm asking you a question, guys. Let me see how many of you can answer. Let's say I have already filed a tax return. Okay, maybe maybe a sales tax return or a GST return or an indirect, whatever, excise return. Okay, so when I've already filed an excise return, and now I realize that I did something which can attract a penal provision in the sense that the thing has already happened, and now I know that somebody can raise a demand against me because what I did was wrong. The moment I know this, can I go and book something in my books as a liability? But I have not been raised. That demand has not come from the department till now. But I'm 100% sure that demand will come because I've already filed the tax return. Should I accrue that liability? Yes, no. Should? You remember, understand it's yes. Okay, because the incidence has already happened. You cannot roll it back. Is it clear? If you cannot roll it back, then you have to accrue that liability. So then that becomes, but then again, it will be a contingent liability which you have to disclose in your books. It will not be a definite liability. Okay. So what are definite liability? These are liabilities that exist at the balance sheet date. And the best example will be something like a salaries, accrued salaries. When you account for the outstanding salaries in your book, it's a definite liability. There is no uncertainty around it. But a contingent liability is something that does not exist at the balance sheet date, and there is some uncertainty that it is dependent on.